Hello, this is Quanric Invest. So Tom Lee recently said that the stock market sell-off is an overreaction. So we'll be covering that today, as well as the overall stock market. So the stock market is up big today. We're up around 1.7%, and it is because of this news headline over here. So Trump and Putin basically had talks, and they are productive right now. They are about to end the war in Ukraine, hopefully. And that is what is causing the stock market to go up and up and up today. And we're up massively today, and I do expect the stock market to go up all the way until its 200-day moving average, which is around $570. I think we'll get there, test it, and then maybe we will turn from there. Who knows? But that's another 2% from here. So yeah, that will be where the stock market's turning point will be. Hopefully it comes down so that we can buy more dips. Anyways, so let's go to Tom Lee over here. So this is what Tom Lee has said about the stock market sell-off.
Welcome. Yeah, great to see you.
Why do you say overreaction?
Well, yesterday really was an indiscriminate selling day. Did Tesla's valuation and fundamentals drop 15%? Did the broad market have a 4% decline in valuations? To us, it really looked like a lot of liquidation. I think investors are, of course, reacting to the White House warning of pain ahead, but it has been more of an equity sell-off than it has been in corporate bonds. So to us, 4% down days, yeah, I think it's an overreaction.
Yeah, what?
So I mean, Tom Lee, his fund has been performing quite well. It's actually down in the past year. I was just joking, by the way. Okay, anyways, so what Tom Lee is saying is because the 10-year yield over here, so the 10-year, the US 10-year yield. Okay, so what Tom Lee is saying is the 10-year yield hasn't spiked up yet. So as you can see over here, the 10-year yield, as in the 10-year yield hasn't dropped yet. So there is no recession fears in the bond market yet, and then the stock market is selling off, was selling off over the past few days. So what he's trying to say is it's an overreaction because the bond market is not pricing in a recession, the stock market sort of is. And yeah, that is why he thinks it's an overreaction, as he said. But for Tom Lee over here, I think he's been bullish almost forever already. It's been bullish since I don't know when, and you will go online and then you'll see all these videos over here talking about Tom Lee. And for me, I think Tom Lee is he's always bullish. Most of the times the market will go up, sometimes the market will come down. But if you are to look at just Cathie Wood, which is the biggest stock market bull in I think 2020. So Cathie Wood was one of the hedge fund managers that manages the ARK fund. So they invested in Tesla, they invested in all the disruptive innovation stuff in 2022. And if you were to look at just the performance over the past few years, it's crap. So see over here, over the past 1 year, it's flat. Over the past 5 years, it's up 14%. It raised up to around $150 in 2021. And then as soon as the tech bubble crashed, the stock just went down and down and down. So for me, I think all these bullish characters, your Tom Lee or Cathie Wood, they're dangerous. Don't be too overly bullish. It is not healthy. And when they start sprouting rubbish like this, where you will double your money, triple your money, the stock market will just keep going up and up and up. It doesn't make sense. Next, let's talk about the stocks that I bought in the past week. So in the past week, I bought this company over here. This company is Amazon. I bought quite a few of the Max 7 companies because they're sort of like in a bear market already. So Amazon over here, this is one of my buys. And then I bought some Google as well. Google is extremely cheap. I think I'm going to look back maybe a year later and think to myself, why didn't I make this 20% of my portfolio? But it's already around 10% of my portfolio, so I don't think adding to it is what I want to do right now. And another company that I added as well is S&P Global. So S&P Global is another monopolistic company that is just quality, high quality. Another business that I added as well is Microsoft. So Microsoft is another one of those Max 7 companies that is basically flat in the past year. In fact, it's down 6% in the past year. And it is currently trading at 31 times earnings, 28 forward earnings. I think that is reasonable for a predictable business like Microsoft. Another business that I added was MSCI. So MSCI over here, it controls all your MSCI World Index, MSCI Emerging Index. And so I bought into this company because the sell-off wasn't justified. It's still a small position. It's about 2% of my portfolio. So I'm looking to scale into this one as soon as it hits around a $500 mark. So as soon as it hits $5, I will go in with another 3 to 4% and make it around a 5 to 6% position. I'm comfortable doing that for monopolistic business like MSCI. It basically just holds a monopoly in world indices. Next, let's talk about Buffett. So Buffett, in the last quarter, he actually sold the entire S&P 500 position. So it was only a very small position. It was more of like a message that he was trying to send to the broader markets. And as soon as he sold it, literally a few days later, the stock market crashed. So I mean, Warren Buffett here, he is extremely defensive now. He has around $330 billion in cash, and that is what I'm mimicking as well. I'm not trying to copy him. I think he's a far better capital allocator than I am, and that's why I think he sees opportunities elsewhere. I think he sees opportunities in Japan, better than in the US, because in the US the equity prices are extremely high. We're priced almost for perfection, and that's why he sold his S&P 500 position, and that's what I'm trying to do as well. So for Warren Buffett over here, he is basically betting that yields will come down. So over here you can see he bought this company called let's take a look. He bought this company. He bought VeriSign. He bought Domino's. He bought Pool Corp. He bought SiriusXM. So all these companies, right? They are extremely susceptible to interest rate hikes. In fact, he is basically betting at this point that interest rates will come down. And so, I think Buffett knows better than us. So interest rates will more likely come down than they will go up. So if you were to look at the Truflation data over here, we are looking at around a 1.3% inflation. So 1.5% inflation over here. I do think inflation is going to trend downwards because of all the recession fears and all that. And so you can start positioning your portfolio towards businesses that will benefit from the yields coming down. So for example, your REITs, your S&P Global, your Moody's, your credit rating businesses, and start scaling out of your banks, your financials. All those companies, they will not benefit so much when there is lesser inflation when yields are down. Last portion, I'll be talking about two stocks that I couldn't add on this dip because they were still not cheap enough. So the first stock is MasterCard. So MasterCard over here is it's an extremely monopolistic, it's a duopoly. Basically, MasterCard, Visa, Cash. So you have MasterCard competing against Visa, and you have Visa and MasterCard competing against Cash. And Cash is a competitor that won't fight back. So I think for MasterCard over here, it is still trading at a premium. I want it at a 33 PE, maybe a 34 PE, and that will be where I'm comfortable at. So for MasterCard over here, I think another 10% down would be nice. That will be the time for me to add into this business. I think it's an incredible business, and it's still growing at around 12% every single year organically. So if you were to look at the past few years or so, the only time when MasterCard lost sort of like revenue was in 2020 when we had the COVID lockdown recession when everyone couldn't go outside and spend money. And so for MasterCard over here, you can easily grow 17% EPS easily over the next few years. You have Visa as well. Visa is growing organic revenue by about 10% every single year. It can easily grow its EPS by around 13-14% every single year as well. So I think these two businesses are extremely durable business. I would love to add them, but for both of them, I would like to have 30 PE for Visa and around a 30 forward PE for MasterCard. That will be the price that I'm comfortable adding at. I'm hoping they get another leg down, maybe another 10% down from here, and then I'll be loading the boat on those.